Markets held up okay on Friday, even though US GDP growth was weak, inflation persistent. Our guest says, though, that pressures are building with soft economic data, particularly south of the border, and uncertainty around tariffs. Let's get more from Ryan Bushell, CEO and Portfolio Manager at Newhaven Asset Management. Ryan, thanks very much for joining us.
Thanks for having me, Andy.
Start off with the U.S. economy. I mean, we've heard that, it's doing fine. There's no signs of big cracks, but you say there are some clouds here?
Well, I was just sort of surprised on Friday to see, weaker than expected economic data, GDP coming in at half what the expectation was. Now, some of that was related to the government shutdown, but regardless, the fourth quarter blowout numbers we saw don't appear to be repeating themselves. And so that combined with a higher inflation number, that is a scary prospect for markets. A stagflationary scenario is something nobody wants to see. Then you combine in with the fact that the tariff ruling, we just got adjusted to these tariffs. Now they're, in theory, maybe being taken off. What does that do to the U.S. fiscal situation, or potentially even being ramped up now with what Donald Trump has done over the weekend, saying we're putting in a 15% tariff across the board. It started at 10, went to 15 before markets opened. So quickly changing circumstances is not something anybody in business wants to see, and that's what we've been dealing with for over a year. We just finally got to kind of a new normal, and now it's being shaken up again. So all of those things point to uncertainty for me. The other thing that's happening is oil prices are back on the rise, and so that flows through to the inflation side of things as well. So a lot of cross currents now to be keeping track of.
What is your broad strategy? Are there areas of the market that you're avoiding right now, Ryan, or underweighting?
Yeah, so anybody who understands the way we invest money knows that we are not tech investors. So as that has been under pressure in the last few months, our type of portfolio has benefited. We've seen money flowing broadly out of the U.S. to anywhere but, so the outperformance in emerging markets and other tertiary markets like Canada. And money seems to be flowing from, call it the digital space, the digital economy, back to the real economy. So tangible assets, utilities, infrastructure, pipelines, all of those companies, we've seen massive moves, which we're happy to see. We were investors in those when people were eschewing them. So nice for us to see that come back around our way. And, we think that this move could continue. Any sort of broader turmoil in markets, we still have huge concentration in technology. We still have higher multiples in technology. So any continued rebalancing of that or any market panic, we would think is likely to be concentrated in that area, to the benefit of tangible infrastructure assets like the ones we own.
Broadly, how are you playing the excitement over copper? Do you feel that's overplayed, Ryan, at this stage?
It's hard, right? And I would like to have more exposure to base metals. It's hard for us as a conservative dividend investor to find the right vehicle. You can buy the big miners, the BHPs, the Rios, but you're not getting sort of that pure exposure. And then on the smaller companies, as we've seen in places like Mexico and South America and Africa, there are risks geopolitically on securing that production. So I think the hype is somewhat overblown. You also have this factor of China's inventories and stockpiling and how much they're going to restrict output because they refine the bulk of the copper in the world. So a lot of cross currents in that space. We prefer, again, to own sort of the end use product, which is, again, it is going into utility-based infrastructure. It is going into electrification, construction, which we own a part of. So we're not directly in that space, but it is worth watching. And for those that are there in a big way, you're seeing, again, money flow from digital economy to real economy is benefiting base metals and obviously gold as well.
You have an interesting trade idea here. Brookfield Infrastructure trades as units, BIP.UN, and then Brookfield Renewable trades as BEP.UN. Now, the company, known for its convoluted structures, has also issued common shares that are the equivalent. I think part of it is to help some investors with tax planning. But you say that the units in both outfits are trading at a discount to the corporate shares?
Yeah, a material discount. So I was on January 20th, and I just went back to that date and looked at the moves in both the unit trust structures versus the corporate structures. Again, the corporate structures, BEPC, BIPC, which trade on both New York and Toronto, are there to service the institutional investing community that can't own a Bermuda-based limited partnership for governance reasons. So the way they got around that was to offer it in a corporate structure, which just is basically a fund that holds the units. So it's the exact same underlying assets, and those premiums for both the unit trusts, the corporate structures over the unit trusts, had blown out in January. And Brookfield themselves came out with an at-the-market equity issuance program of the corporate units to buy the undervalued trust units. So as a Canadian investor, where you can buy those trust units, still get dividend treatment, the full treatment in your RSP or TFSA, where you don't have to worry about the different tax treatment in your taxable account. We think it's a very good trade. No, we're not in it for the trade. We just think for our clients, if we can buy the exact same company with a 0.75% higher yield, that's going to do us well over time, and we've seen that. So since January 20th, both unit trust structures have outperformed the corporate structures almost 2-to-1. So it's about 12.5 for the BEP units relative to the corporate units, up about 7, and about 11.5 for the BIPC units versus the corporate units, up about 6. So not bad for a month's performance.
And just finally, Telus raised eyebrows by appointing a former boss of CIBC as its new CEO. You welcome that move? You think it's plausible?
I think it's fantastic. When I heard that news, Rebecca and I were talking about it in the morning, and she said, "You'll never guess who the new CEO of Telus is." And I started thinking about different. I said, "Is it a telecom person?" She said, "No." I said, "Is it Victor Dodig?" And she said, "Yes." And I said, "Wow, that is best case scenario." Victor did an amazing job at CIBC, turned a bank around that really didn't have an identity, was struggling on the consumer side, and really brought a cultural shift to that bank and really good earnings performance. So that's all you want to see. Telus is in exactly the same position. Now, different set of circumstances, and not to disparage anything Darren Entwistle has done over his long tenure at Telus, but they were in need of a refresh. They were in need of a cultural shift, and they're in need of a leader that I think can bring this company forward into, a new set of circumstances for the telecom sector in Canada as the technology behind it changes as well. So I'm really positive on this move. I think they're very lucky. A lot of these former bank CEOs, usually they stay on the board and they're still active in companies, but for him to actually take on the CEO role and put his butt in the hot seat, I think that speaks volumes, and I'm very positive on people that can lead culture.
Thank you very much, Ryan. Ryan Bushell, CEO and Portfolio Manager at Newhaven Asset Management.